Will a U.S. Iran accord finally cool energy prices and calm markets? Here's what a potential reopening of the Strait of Hormuz could mean for your portfolio. After months of tense negotiations and sporadic clashes, Washington and Tehran have a framework to de-escalate. European leaders quickly backed it, signaling targeted sanctions relief if milestones are met. The shared priority is clear: reopen the Strait of Hormuz and restore reliable flows of crude and LNG. That choke point carries about 20% of seaborne oil and roughly a quarter of global LNG. When it's constrained, freight jams build, prices carry a risk premium, and inflation pressures linger. A formal channel for dialogue replaces ad hoc crisis firefighting. That alone can reduce headline shocks. Europe's shift from purely punitive measures toward conditional engagement adds policy incentives, not just penalties. With major economies aligned, enforcement and monitoring look stronger than in past piecemeal efforts. The goal is no longer vague normalization. It is explicit access for shipping, quickly. Why this matters for investors is straightforward. Lower shipping risk can shave the geopolitical premium from energy prices. That can soften input costs for manufacturers and transport operators. It can relieve margin pressure and support equity valuations. If fuel prices stabilize, central banks get cover to lean less hawkish, especially in import-dependent economies. Inflation expectations could ease at the margin, helping duration assets. Sector impacts may split. Upstream oil producers could see realized prices drift lower if the risk premium fades, but they gain planning visibility and steadier loadings. Integrated energy majors with LNG businesses may benefit from more predictable cargo schedules and fewer delays. Tanker owners, ports, and logistics firms stand to gain from higher, smoother throughput. Energy-intensive industries could see improved cost baselines if benchmarks steady. In credit, high-yield energy names may enjoy tighter spreads as cash flow outlooks firm with fewer voyage disruptions. Any retracement in crude can offset that, so net effects depend on the balance between price and volume. In rates, softer energy risk can nudge inflation expectations down, which supports longer duration bonds where fuel costs pass through to consumers. For practical positioning, focus on the path of Hormuz access rather than headlines alone. Track spot and futures spreads in crude and LNG, marine insurance rates, and shipping day rates. Watch inflation break-evens and central bank guidance. Tilt toward quality in logistics and integrated energy. Keep hedges on pure-play upstreams, and consider selective duration if inflation relief broadens. Read the full article at finlitica.com.